Thank you very much. I'm assuming my camera is on.
All good, Glenn.
Yes. Great, thank you. Thanks, guys, and I'd like to thank everyone for their time today. Look, Calima has been involved in Canada for the last 5 or 6 years. We went into the Montney early on. We drilled 3 wells. We built up a resource base of 2 TCF of gas, and frankly, we were about 3 to 4 years too early for the cycle. With that, we realized that we had to expand our footprint in Canada. We know that Canada is a tier 1 jurisdiction. We've got an oil and gas industry that goes back 60, 70 years. You know, last year somebody called me on Skype. Last year, they drilled 3,000 wells in the province of Alberta. You know, it makes up about 25% of the GDP, the oil and gas industry, and it accounts for about 10% of the employment. So we're in Canada for its jurisdictional base, for its first world ESG track record. It's got carbon pricing, and mostly also because it's got the 3rd largest oil and gas reserves in the world. The assets that we've bought and we've merged together with Calima are the Blackspur Oil assets. Blackspur actually is a very, very low cost operator in Canada. Their operating cost per barrel of oil is $10 Canadian a barrel, and they break even at $26 WTI per barrel. Difference between the $10 and the 26 is royalties and other indirect costs based on which are a function of production. The assets that were bought have been in production for 7 years. There's no historical tail obligations attached to other assets that have been drilled in Canada. Or just to give you an idea, in Alberta, there's over 160,000 wells that have been drilled over the last 30, 40 years. Many of those wells have to be abandoned, and there's abandonment obligations attached to those wells. The assets that Blackspur has, the company's been around for less than 7 years. There's 60 wells that are in production, or 50 odd wells out of the 60 that are being drilled that are in production today. So we've got a very, very young company with a very low abandonment obligation and is well positioned for growth going forward. But most importantly, what we do have in Canada with our Montney position is we're now positioned to take advantage of the LNG industry and the upside that will generate for the gas prices in Canada. And as we know, in Queensland, that drove energy prices through the roof about 10 years ago when there was 3 LNG facilities that were built in Queensland, and we expect that to happen again going forward in Canada. But unfortunately, as I said, we're a little too early in the cycle. Next slide, thank you. Just to give you a corporate snapshot, we'll be relisting next week on the ASX. The transaction with Blackspur completes today in Canada. Once we complete, we'll have around 10 odd billion shares on issue. And yes, that is a large number of shares. And yes, it's more than I ever anticipated I'd ever be the chairman of a company with that many shares. But what it's going to do is it's going to create a great trading opportunity for many people, and it will provide significant liquidity. We'll have a market cap of around $70 odd million based on our capital raising price of 0.7. And most importantly, we'll have access to significant credit facilities from National Bank of Canada, totaling around $25 million. And those credit facilities will fund our growth. And one of the things we intend to do with Calima is grow the production base and grow it with a rising energy price. When we entered into this transaction with Blackspur, the oil price WTI was originally $45. It then moved to $53 when we paid $1 million deposit in February. And today, the oil WTI price is $65. Anything above $26 for us is profit. So we're in a very, very strong cash generative position, and we're going to, quite frankly, knock the socks off for people with our EBITDA numbers at the end of this year. We've forecast an average production this year of 3,000 barrels of oil equivalent a day. Of that is 70% is oil and 30% is gas. You have to be careful with companies that talk about oil equivalent production, and you want to know what basis of that is oil versus what is gas, because oil trades at $60 odd WTI, gas trades at $2.80 to $3 Canadian per MCF. And the ratio of gas to oil is 6 to 1 in terms of normal valuation. So while you may have a company producing 1,000 barrels a day of oil equivalent that come out, but when you realize that it's actually it's 90 odd % gas, that's the equivalent in terms of dollar value of probably 200 barrels a day of oil. So we are very much an oil focused company with associated gas coming out of those wells. As I said, we've got really low operating and transport costs, but most importantly, because this company's been managed by a team out of Canada and built by a team out of Canada that I'll mention earlier on, we actually have a large proved reserve base, a 2P reserve number of 22 million barrels. And we have proved developed producing reserves, which is where the existing production is coming from, of 5.4 million barrels. So we're not per se an exploration story with, let me go and drill a well and I'll tell you whether I'm going to have 50 million barrels or 30 million barrels, and 3 years later I can bring it into production. We're a development story. So I'm very pleased in terms of having an asset that we can be very responsive to a rising energy price. Next slide, please. As I said, our story is, quite frankly, extremely compelling. I've been involved in the oil and gas sector for many, many years. It's probably, I think, the best story that I've ever put together with the team that we've got today. We've got a de-risked asset base because we've got a reserves. We're drilling onshore in Canada. We've got assets that generate significant free cash flow when oil's above $26 a barrel. We would only shut in our production with oil below $26 a barrel. We have exposure to the LNG industry through our Montney acreage, which is, as I said, a very large unconventional gas reservoir, which will be delivered to the LNG export sector. We have very strong netbacks. At $65 oil, we're basically generating about $40 netbacks. Most importantly, we have a great management team in Canada, led by Jordan and Braden, the CFO and CEO respectively. And now that we're listed in Australia, or we are listed in Canada, we bought the Canadian assets. I think we're going to have liquidity on the ASX. Next slide, thank you. Today, as I mentioned briefly earlier on, current plan is that we've told the market that we're going to have 3,000 barrels a day of production during the year. Our target is to basically increase that by 60–70% with the rising oil prices. We're going to commence a drilling program in May. Our intention is to drill 1 well a month for the next 24 months, basically. And I think with energy prices above $60, you'll see us accelerate that program, which will then accelerate our production, which will accelerate our cash flow. We mentioned in the medium term that we want to grow our production to 5,500 barrels a day at year-end 22. With the rising energy prices, because we can bring a well on production within 6 weeks of drilling that well, while our energy prices are high, we're going to aggressively expand and increase and bring forward our drilling plans. And our objective is to manage our balance sheet very prudently, to keep debt at a very low level, but most importantly, to use that debt facility to allow us to fund the working capital attached to drilling the wells, completing them, tying them in for production, and then generating revenue. The longer term plan, as I said, is to grow through 5,500 barrels a day and actually, quite frankly, reach 10,000 barrels a day. And then also we have our Montney assets, where we have plant facilities and infrastructure that, with a higher energy or gas price above, $3 in the long term, we would be able to bring on another 11,000 barrels a day of capacity. Lastly, what we plan to do is, you'll see there's a number of little bolt-on acquisitions and tuck-in acquisitions, as the Canadians love to call it, from existing leases. Nothing too earth-shattering, but they will be bringing on acquisitions of 500 barrels a day, 700 barrels a day, and that will also be further upside. Next slide, thank you. In terms of our valuation of our peers, we're trading at the bottom end of the spectrum. We're doing that because we've been off the boards for 3.5 months. This transaction's been under negotiations since actually November last year. The oil price started to move in February from 45 to 53, today to 65. So I anticipate, first of all, a great re-rating when we come back on the boards next week. And then thereafter, as we start to deliver increased production flow rates and increased revenue, and we show you how much EBITDA we're going to make each month, I can see some tremendous upside in the story, but based on fundamentals, not based on something that we're going to be delivering in 3 or 4 years. It's going to be based on results that we'll be delivering in 3, 4, or 5 months. Next slide, thank you. Just to give you an idea of our cash flow, what we're looking at, most people think that this is these numbers are very ambitious. These numbers are what we know we can deliver. I think the best thing is, if you look at $60 oil, the bottom graph, at 3,000 barrels of oil equivalent a day, we have an EBITDA of $25 million. If you look at 5,500 barrels of oil equivalent a day, we have an EBITDA of $58 million. And that's something that we believe we can achieve within the next 12 months based on our plans as they sit today. And the reason we can do that is that with high energy prices, and one, because Blackspur spent over $200 million on their assets. There's a tremendous amount of infrastructure and facilities and services that are already in place. You know, they drilled they prepared well pads where they were planning on drilling 4 to 6 wells. There's only 1 well drilled. So we're going to go onto those well pad locations and drill the next 2 and 3 and 4 wells. And these aren't exploration wells, these are development wells. And development wells obviously carry some risk in terms of completion, that, you know, the drillers, there's a problem with the drilling, or we lose a hole and so forth. But in terms of is there recoverable hydrocarbons in the ground? We know there are, because we've already got wells in production from adjoining reservoirs. We've drilled 62 wells. We've got 54, 55 on production, and we have a reserve base. So we're targeting to deliver the $60 oil, these EBITDA numbers, as you'll see in the middle. And I do believe even we'll be able to achieve that going forward. My personal belief is that the oil price is actually going to go for a decent run. And I think after years of underinvestment, we're going to see the oil price at $100 a barrel, up from 65. Strong board and management. Everyone tells you they've got the best board and the best management. You've never seen a presentation that says, you know, I've just put a board member on there because I like them. They're going to do what I like, and they're going to follow my instructions. That doesn't happen with our companies. Jordan Keebles, a fabulous asset. He's a geologist. He's been involved in the oil and gas industry in Canada for many, many years. He's supported by Braden Vasseur, who's his CFO. They worked together for 6 years. And then the rest of the Blackspur team that have been there and worked together. It's a team that's been proven, that's delivered results, that's taken Blackspur from a concept and idea to a company that we've now merged together with Calima. On the board, we've got myself as chairman, Alan Stein, who was involved many years ago in Ophir and also Fusion Oil and Gas, great exploration, good geophysicist, geologist. Lonnie Tetley, which is a Canadian lawyer involved with the Blackspur shareholders, very, very strong business, and also Brett Lawrence. Yes, we've got the slide, cash flow asset base with long-term upside. Infrastructure facilities, you can see that's already been built. These aren't shot photos, these are actual photos of the infrastructure facilities the company has, not photos of somebody else's assets. These are ours. 2 assets, the Brooks and the Thorsby. The Brooks is doing about 2,300 a day barrels. The Thorsby is doing 5,500 a day. Brooks, we have 94 working interest, Thorsby 100. And most importantly, you'll see we've identified in the Brooks 147 drilling locations, of which 35 are booked as reserve locations, and the same for the Thorsby, 101 and 28. So we have a drilling inventory that we can drill and drill and drill for the next 2 years without actually having to replace that inventory. Oops, we've gone too fast on that slide. If somebody could bring me back to the previous slide, thank you. And as I said, you can see the breakdown between the 1P reserves and the 2P reserves. And you can see that we're very robust. And because Blackspur was a private company for the last 7 years, funded by family offices and high net worth individuals out of Calgary, they haven't had to aggressively book reserves. And I think you'll see over the coming 12 months, when we come up with a new reserve adjustment, I think you'll see some real positive adjustments in our reserves. Next slide, thank you. Just to give you an update of a snapshot of the leases. The lease areas are in green. The gas plants are in green. The non-operated gas plants are in red. We're in an area where there's significant wells being drilled. Those little grey lines are horizontal wells that have been drilled. You can see our leases. We've got a very good infrastructure base, and you'll just see tying in around the Brooks area and so forth. We'll fill in some of those white areas, a bit like Tetris, and turn them into green lease areas. Very low cost, but we'll just keep consolidating our position and growing our position and growing our acreage holding there, which again will allow us to book more reserves, which will then provide us with replacement reserves as we drill existing identified drilling locations. Next slide, thank you.
Glenn, I just might interrupt. If you could wind up, please. I know it's a big story, but we're just almost out of time. If you don't.
Okay, well, Thorsby. All right, thank you very much, Thorsby. Oh gosh, time went very quickly. Thorsby, similar. Go to the next slide. I'll go. Keep going. Okay, just a thing on the Montney, where we sit in the Montney today. It's one of the largest unconventional gas basins in North America. Tremendous upside. There's multi TCFs of gas. There's been a consolidation going on by the major Canadian players. We have just under 2 TCF of contingent resource. We've got a gas plant facilities. We're connected to the pipeline grid. But again, we went into the market too early. That will be revalued over the next 24 months, and it will be revalued quite significantly as LNG Canada comes on stream. Next page, thank you. That's just acreage. You can just see through the boxes, there's been over $1 billion of M&A activity that's happened in the last 12 months in Canada. We're going to be a part of that M&A activity going forward, just on the Montney area, which is the yellow area identified on the lease. Next map. Our forecast, average production 3,000, calendar 21, 2,900. This is our original numbers pre-rising oil prices. As I said, we modeled this business at 5,000 barrels a day. We're going to excel that, and we're going to exceed that, and we're going to shoot the numbers out of the park. But as you can see, adjusted EBITDA of $25 million, and in 2022, $49 million. Next slide, please. Environmental ESG, carbon pricing. Canada's first world country. It's got carbon pricing. It's got the best ESG records in the world. We're very happy to be operating in Canada, and capital will go to countries that have the best ESG track record and also carbon pricing. Next slide. Social governance, again, we've mentioned the board, and we're engaged, and we work very actively with the local tribal groups. We have arrangements in place. We have programs in place for those. Next slide. And finally, we're a free cash flow generating company. We have exposure and talk to the upside in oil prices. We're protected on the downside at $26 oil, and we've got the ability, when oil price runs even more aggressively than it has, that we can drill 2 wells a month, 3 wells a month, 4 wells a month, which means news flow in every well, which means revenue from every well, which means an increased cash flow, which means increased EBITDA. So we can respond extremely quickly to rising oil price and deliver results for our shareholders. Thank you.
Thanks, Glenn. We really are out of time. It's a very different story to the one we told some time back. Is there any hedging put in place in regards to, as the oil price rises, to kind of protect some of the downside?
There's a small amount of hedging that's in place as a requirement of the bank facility, and it's about a third of the baseload production, and it's still there. And some of that hedging's at $45 and $48 because that's where it was put in place months ago. But that's only for about 600 barrels. That will roll off, and it's no more than 12 months. Our philosophy is we're only going to hedge the capital that we're going to spend on new wells. So we can drill a well at $60 oil and repay the capital in 6 months. So we'll hedge that 6 months of production out to lock in our capital to make sure we get it back. And that well will then produce anywhere from the next 10 to 15 years at a zero capital cost base, other than an operating cost base of $26.